Good morning, and thank you for joining us for today's free webinar, Startup Fundraising 101. Are you ready for an investment round with Shane Vermali of DLA Piper and Cirque Rowe from Early Growth Financial Services? My name is Gina Longmire, and I'm the Marketing Manager for Early Growth Financial Services, and I'll be your moderator today. This presentation will run about 40 minutes. If you have any questions as we go along, please feel free to enter them in the question field or tweet them to us at earlygrowthfs with the hashtag startupfunding. We'll answer all questions as they come in if we can, or if not, we'll save them until the question answer period at the end of the presentation to address them. If we run out of time, we'll be sure to follow up via Twitter and or email after the presentation to make sure that all of your questions have been answered. You'll also be receiving an email tomorrow with the link to the deck and this recording. I want to start by introducing our presenters. We're very pleased to have with us today Shane Vermali of DLA Piper. Shane leads the East Coast effort of DLA Piper's venture pipeline. Shane works with the firm's emerging growth clients to prep them for fundraising while leveraging relationships in order to obtain capital. He rapidly analyzes deal potential and helps management teams hone their investment materials to take to market by scrutinizing various aspects of their business plans, execution strategies, and financial models. Shane also works directly with the investment community, including angels, seed, early stage, growth, and buyout funds to align investors' specific criteria with corresponding deal flow. Shane's background before joining DLA Piper centered around finance and operations. He started his career as a private equity placement agent for a financial entrepreneur group investment banking division. From there, he pursued a career in venture capital, where he was principal with the NJTC Venture Fund and was responsible for investing nearly 60% of the fund with a focus on clean tech, advanced materials, life sciences, education, and information technology. Shane is well versed in deal structuring, business strategy, due diligence, and financial analysis. Following his venture tenure, Shane spent several years on the operating side, including Highcrete Inc. to head business development and sustainability, iLevel Solutions as Director of Analytics, and JP Morgan as a Senior Business Analyst and Project Lead for FinTech integration into the firm's private equity alternative investment services unit. Shane attended Indiana University's Kelley School of Business, graduated magna cum laude, and studied finance and international business. Shane Vermali, though, is not a lawyer. Welcome, Shane. We also have, of course, thank you for joining us. We also have with us Cirque Rowe from Early Growth Financial Services. Cirque is the Chief Operating Officer for Early Growth and has served 25 plus years of finance experience, with 17 years serving in financial leadership roles with high-tech companies. He is an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. Welcome, Cirque.
Thank you, Gina. That makes me sound old, but thank you very much.
You are far from old, don't worry. And before we get started, I was hoping each of you could kind of tell us a little bit about your corporation. So Shane, could you start off by telling us a little bit about DLA Piper?
Sure, absolutely. So DLA Piper is actually the world's largest law firm. We're in 36 countries, about 4,200 attorneys, and we are very active in the emerging growth space. We consistently place within kind of the top 3 or 4 law firms for both early and late stage venture activity, as well as private equity opportunities as well. We have offices all over the U.S. We kind of span the globe. This unit is specifically focused on advising clients through the fundraising process and helping them with that endeavor. Essentially, it's a free investment banking platform that's unique to DLA Piper. And we basically coordinate across the globe to find great companies and basically connect them with great capital.
Great, thank you so much. And then, Cirque, could you tell us a little bit about Early Growth?
Sure, absolutely, Gina. Early Growth is a financial and accounting outsource firm. We work with small and medium-sized companies, and having started here in the Bay Area in California, when we say SMB, we typically mean tech startups, and so we're very much of a player in the tech community here in California, as well as other parts of the country, and help a lot of companies through their accounting and financial needs, as well as things like fundraising. We have offices across the country in many of the major metropolitan areas, including including San Francisco, Los Angeles, New York, Chicago, Austin, Texas, Boulder, Colorado, Seattle, Washington, and we also have a satellite office in Las Vegas, Nevada. And we work with 400 plus clients, active clients. We have a team of 25 CFOs, and we have a team of 60 plus accounting professionals. And we work with clients on an as-needed hourly basis for earlier stage companies that need our services but don't necessarily need to or want to hire people full-time. We provide 4 types of services. We do corporate tax returns. We do 409A valuations, company valuations for companies giving stock options to their employees. We do transactional accounting and bookkeeping, so that's the day-to-day, including full balance sheet account reconciliations on a monthly basis. And then finally, we provide CFO level services for higher level strategic type of consultation, including fundraising.
Awesome. Thank you so much, Sirk. And we have a lot to cover today, so why don't we go ahead and dig in?
Sure. So these are the things we're going to be covering today. It's obviously a fundraising topic. We're going to talk about why we raise funds, and the fact that not everyone necessarily needs to or should be raising a lot of funds. We'll talk about the different options that are out there. We'll touch upon the process, the way that you go about doing it, the way that you think about the way you do it, and who you're going to be talking to and when you're going to be talking to those people. We're going to really stress the network of everyone that you know, and how you leverage the people that you know in your fundraising efforts. We'll definitely speak a little bit about what investors want to see, and when we say investors, we typically mean equity investors, so angel investors and venture capitalists, what they want to see, and then finally we'll kind of do a few little last minute tips when you are actually fundraising and when you're doing presentations to investors. So the reasons to raise funds, and this is a key one, and for a lot of entrepreneurs, the first thing that you need to think about, the kind of company you have and whether it's fundable or not, and the type of fundraising that you're going to be doing. But the key thing here, and in many of these things, we're going to be talking about equity investment, right? So there's other types of debt instruments, there's friends and family, but when we really talk about raising funds, we're talking about going to outside investors, angel groups, and venture capitalists, and for those folks, it's really about the timing, and it's about accelerating the growth. So for most tech startups, right, it's so easy these days to be able to develop software, to develop a product, to have a website up and running, and it doesn't cost a lot of money, and it doesn't take a lot of time to do those things. So, those are things that you should be doing on your own with the investment that you're making, maybe borrowing a little bit of money from your friends and family, maybe taking out a little bit of debt. But these are things that you should be doing on your own. Because by this time, you really already want to have at least a working prototype, or at least you want to have a website that's up and running and gaining a little bit of traction. You want to have kind of thought through the market, and you want to be able to validate the market. So all of those things, if you've already got that, and now it's a matter of accelerating your growth, and it's about expanding your company and expanding your network. If it's about timing, the fact that you have a certain amount of time to really gain a foothold in an up and coming marketplace, or you see that there are players doing it but they're not doing it correctly, and that you got the right approach to a solution to a problem in the market. That's really when it really makes sense, and the reasons to raise funds is there, as opposed to hey, I've got a great idea and I'd love for someone to give me a couple $1 million so I can figure out whether it's going to work or not. That's not going to fly with equity investors. Shane, do you have any comments on that?
No, I totally agree. And as we segment into the next slide, I think one thing to kind of keep top of mind is this capital is a very specific type of capital, especially as you look at the seed and venture stage rounds, even growth equity. But one thing to keep in mind is the expectation is that it's all about hyper growth, exponential growth, not linear growth. Those are the opportunities that these guys want to see. If somebody's just going to pace along growing 20% per year, that's really not the type of company these investors want to see. It's all about explosive growth, kind of really changing the dynamics in the market, and also really just going after a huge opportunity, but also getting there very quickly to an exit.
That's
If no
that's exactly right. Yeah, great point.
Yeah, and if no exit is visible, you might want to rethink your approach to these investors, because at the end of the day, you need to be aligned that you're in it to win it, and you want to get out at some point, and that there is a way out. There are certain companies that bode well for an IPO or an M&A, and there's some businesses that are just great to have as a lifestyle business or something that you can run for the rest of your life. Those types of businesses tend to be not really oriented to venture capital. They may be more suited towards PE or venture debt down the line, which I think we'll get to in the next slide. But those are the types of ingredients that need to go into the recipe to make a winner.
Great points, Shane. Okay, so these are the different options that are available to you, and some of the time frames, and kind of the order. So you can kind of see, look at the arrows. This is starting from kind of the smallest amounts, towards kind of going to bigger and later stages. But we'll talk about all of these things. We'll talk about bootstrapping and self-funding, and for companies like Shane was just mentioning, that's a lifestyle company where you're going to be able to grow your revenue, methodically, slowly over time, and you're gonna make money, but it's not necessarily going to be hyper growth. And bootstrapping and self-funding with other little debt instruments along the way would be a great way to go. Friends and family, we'll talk about that, and we'll talk about the fact that in my estimation, it may be some of the easiest money to get, but in many ways it's the costliest money that you're going to raise. So we'll talk about that, and that's kind of how you really get started. As you really get into the ideation, as you start kind of figuring out what the market is, and as you start working on your product, and it's starting to come together, the website is coming together, you've got some traction at that point in time, and you see the hyper growth possible. At that point in time, that's kind of when you're going to be looking at the angels and VC type of money, and depending on kind of how far you've gone along and how much money you need, that's probably going to make a big determination as to whether angels or VCs might be more appropriate. Depending on, again, on the kind of company, crowdfunding might be an option here as well. We don't speak about that much. We do talk more in terms of angels and VCs, but depending on the kind of company you have, crowdfunding would also make sense. As we get a little bit later, then I think that you're talking about things like obviously using customer and vendor terms. So, for example, being able to get payment terms when you purchase things. Credit cards is one way. You get a 30-day or up to a 30-day lag between purchase and payment. Anything like that helps you to push out your cash flow requirements is really good. And so, leveraging your customers and your vendors and working the cash flow that way is one of the options. Venture debt, we'll touch upon that on another slide, and go into a little bit more detail. As you get a little bit later, and as you really have some traction, and as you have revenue, and as you have possibly assets on your balance sheet that can be financed, then you're probably talking about being able to go out to banks and get traditional type of loans, which tends to be amongst the cheapest money that you can borrow and be able to use to finance your company. Shane?
Yep, no, I totally agree. I would say, one of the things too is that there are a lot of funding options. There's a record number of funds out there, kind of in the sub $50 million range right now, that are focused on seed stage investments. Those are kind of high pace investors that typically will do 4 to 10 deals a month. While capital is out there and there's plenty of it, there's also plenty of companies out there as well, and the odds are still pretty much the same. Basically, 1 out of 1,000 plans or so might actually get funded. So the bar is still high. Doesn't mean that people are slacking and that the barriers are any lower. just because there's more money out there. There's still a lot of competition in the markets for various companies, and it's just something that you need to be aware of. But because of that, I think you can be selective in terms of the types of funding that you go after, as kind of outlined in this slide here. And it really depends on the dynamics of your business, which one makes the most sense.
Absolutely.
We have a question. What about SBA loans and grants?
Yeah, so I mean, look, anything that works in the early days that kind of gets you to the next step, I think you have to entertain the possibility of. Capital is pretty scarce in those stages. It also can be a great supplement to maybe a recent round of funding that came in. It really just comes down to the covenants and things like that you're comfortable living with, and whether there's any restriction that prevents the business from moving forward.
Perfect. Are we ready to move to the next one?
Yes, we are. Thanks. So let's talk a little bit about friends and family, and we didn't even touch upon kind of the self-funding, but obviously that's the first. The self-funding and the bootstrapping is obviously the first option, and those are things that you should be making an investment in your company. And there's probably going to be some capital invested in addition to the sweat equity that you're going to be putting in, and that's kind of expected. No one should be no entrepreneur should not have any skin in the game. But after that, it's very, very easy and natural for us to reach out to our friends and family
Sir,
for
sorry.
whether they're loans or whether.
Oh, sorry,
Yes.
sir. Before we get into this, I just had a question pop up that someone had missed when you had said, what type of investor does 1 out of 1,000 companies get funded by?
That's typically venture funding. It's seed venture. It depends, but it's usually on the earlier kind of growth stages.
Yeah, so we're talking about equity investors,
Correct.
right?
Yep.
So we're not talking about SBA loans. We're not talking about loans from the bank. We're not talking about other types of financing. When we say 1 out of 1,000, we're talking about kind of 1,000 companies that are out there putting together pitch decks, trying to get equity investors, and really only 1 out of 1,000 is really going to get any significant amount of equity financing. Hope that answers the question. Okay, on the friends and family, and so the photo here, as old as it is, I think it still kind of hits upon the main point, right? And this is what I want everyone to think through when they think about friends and family, and it's that it's people who love you, it's people who want to see you be successful, and so when you go to them to talk about getting an investment or a loan from friends and family, they're going to want to say yes to you, but please keep in mind that these are people that you're going to be sitting across the table over Thanksgiving or over the holiday meals for the rest of your life. And money's going to come and go, but friends and family are once in a lifetime thing, right? And so be very, very careful. Think through really that investment that they're going to be making. Really think through as positive and as optimistic as you are. The law of averages, the law of numbers say that most startups are going to be are not going to be successful. And so it's not a matter of, hey, someone lends you $10,000, and if things go well, it's going to turn into 20 or 30, but if things don't go well, you'll still get back 5 or 6. That's not the way it works. When they're making an investment at this stage, they should be fully expecting that not fully expecting, but there's a very, very good probability that they will lose their entire investment. And that is something that you need to be very, very explicit about. It should be money that is not needed for retirement. It's not needed for grandkids' college funds. It's absolutely money that if they lose 100% of it, they're not going to bat an eye. They want to be helpful. They want to see you be successful. But if it turns out that it doesn't work, then neither you nor the investor, your friends and family, are going to be put off by it. And that's something that you need to not only feel comfortable in explaining to them, but you need to feel comfortable yourself with this.
Yep, totally agree. It's just tread lightly, but take capital when you can get it, but just beware of the consequences.
Yeah, absolutely. The next group is, and we kind of put it together into one slide. It's angels and super angels, and so this is, and Gina, if you could go to the next slide, thank you.
Yes, just really quickly, we have a question. Why is
Of course.
convertible debt better than equity?
Oh, well, convertible debt at this stage. So we'll talk a little bit about convertible debt on a later slide. But when you're borrowing money from friends and family, you're not going to really be doing equity, because in order to do equity, it requires a company to have a valuation. It requires a company to say, hey, I'm worth this, and you're giving me this, which means you're getting a percentage of the ownership of the company. And with friends and family, there isn't enough sophistication. There's lots of reasons why, including that, but there isn't enough sophistication. It's too early for you to really value your company from an equity standpoint. It doesn't make sense for you to be giving out, stock at this stage. And it's also a lot more, cumbersome, a lot more unwieldy from a paperwork standpoint and a legalese standpoint. So, for this kind of for friends and family, typically you're going to take it as a loan. It's going to sit on your balance sheet as a loan that is supposed to be, quote unquote, paid back to family. But then what happens is that, the understanding is that, and you'll paper it such that when there is a round of financing, an equity round of financing that is priced, that is valued by outside investors with the wherewithal to be able to do so,
Yep.
that it will turn
only
into...
one thing I...
Yes, Shane?
Yeah, I said the only thing I'd add to that too is that if you misprice a friends and family round, it can be extremely painful for those people if an investor is to come in, like an institution, like an angel or another VC, and ends up being a down round. It's going to be heavily dilutive to those friend and family members. So it's just something that helps manage some of the downside protection for them.
And quickly, guys, we
Great, great.
have a couple questions. One question said they heard you say take capital where you can get it, so having more than you need in the bank is a good idea.
There's obviously trade-offs. Yeah, I think from the standpoint of actually fundraising, in most cases it's very, very difficult, and when capital is available to you, you want to take it. But we'll talk about this a little bit later in the presentation. We'll talk about things like milestone financing, and we'll talk about how much company you're giving up, the dilution of the company, and how much stock you're giving up to get capital. And you have to weigh the pros and cons. You don't want to take $10 million just because it's available to you, if it means you have to give up too much of your company to do it. Instead, you should be thinking about, okay, these are the things that I need to be doing with this next round of financing, or the amount of money that I'm raising. If I do the things that I know I can do, then I'm going to get a much, much higher valuation at my next round of financing, and I'm going to be able to give up less of the company in order to get the same amount of money down the line. So it's a trade-off. You want to take capital when you can get it, but you want to be careful about taking on too much at too early of a stage, but you're setting yourself up for, first of all, down rounds if you're not successful, and then secondly, even if you are, then you're probably giving up too much of your company early on.
Perfect. And then there's another question. Friends and family can actually own a lot of a company by giving not a lot of money via convertible debt. Is this true?
I guess it's theoretically possible, but in most likelihood, you're going to be setting terms on the convertible debt with the friends and family, such that if you raise any kind of a significant amount of financing in that first round of equity financing, probably not if the friends and family are loaning you or investing in you a small amount of money. Relatively speaking, it's not going to turn into a huge equity stake.
Great, thank you. Sorry to interrupt you. And then do we want to move forward from angels and super angels, or did I interrupt you mid presentation? I'm sorry about that.
No, yeah, we're still on angels and super angels. We didn't really get started, but angels and super angels are really, and the line is really blurring, right, between what you call an angel, what you call a super angel, and even what you call micro VCs. But for the most part, the difference between angels and angel investors and VCs is that angel investors invest their own money, and VCs actually raise funds by going out to pension funds and big deep pockets and raising other people's money and investing it on their behalf. And so for angels, we're typically talking about high net worth individuals. They may have made their money, they may have just family money, they may have been born into it, they may have made a lot of money through either investment banking, or they may have been tech entrepreneurs themselves and had a couple of exits, and now they've got a lot of money, and they don't necessarily want to run their own business anymore, but they want to invest money. They tend to be not as sophisticated as investors. You can expect angels and super angels to write checks in the $25,000 to $250,000 range, maybe even a little bit more now, because again the lines are blurring. You can expect a 3 to 6 month process, to kind of negotiate, discuss, and close the terms. A last point is having a point person. So if you're going after angel investors, think about 4 or 5, 6 different angel investors who are writing individual checks. You want to have a point person that you're talking with that's going to kind of speak on behalf of the angel group, so that you're not having to answer questions and work closely with a bunch of individuals, because that's going to be draining on you. On the super angel side, it tends to be a little bit more institutionalized, like this says. The due diligence is more stricter, more diligent, for lack of a better word. And in this case, I think that that you can expect them to behave more like a traditional VC, and you should be prepared, for that type of activity. Shane, do you have comments to add to that?
Yeah, the only thing on this slide, I think it kind of touches on one of the questions that was just asked about convertible debt. There's also kind of the emergence over the last year and a half, 2 years, of what's called SAFE, which is a simple agreement for equity. From a company standpoint, there's very limited downside. It's basically agreeing that at some point in time in the future, there really isn't a maturity on it, that the people investing will get equity. It's a very simple, quick, and fast way to generate deal docs. There's actually a whole set of them on Y Combinator's site. So if it's something you guys want to check out, feel free to kind of peruse. There's even an overview that kind of outlines the different terms and structures, talking about valuation caps and discount. But it is something that's emerging, and it's a very quick way to raise capital. From the investor side, it's not as compelling, because there really isn't an interest rate or anything like that that's accrued in the interim, as you would have with the convertible note.
Fantastic.
I would even touch on, in terms of angels and super angels, that the bar is still pretty high. They do want to see products that are near launch or somewhat developed, just because the cost of creating companies has been driven down so low. But at the end of the day, in any of these cases, you're still betting on the jockey. So everyone wants to see a really strong management team or brilliant individual that's that's kind of done this before, has a really good path outlined to go forward.
Yeah, that's a really good point. I get a question asked of me also frequently, because I know we're kind of drifting off a little bit, but this is a kind of a key point. I get sole founders who ask me, what about sole founders as opposed to founding teams? And I can tell you that most investors are a little bit more wary of sole founders for several different reasons. It just adds risk, right? And one of the things you're trying to do as an entrepreneur looking for financing, you're trying to minimize risk. You're trying to maximize potential. We talk about things like high risk, high reward. That's not what investors are looking for, right? Investors are looking for low risk and high reward. And so everything that you can do to minimize risk from their standpoint, you're going to be much better ahead. And sole founders are riskier. Obviously, everything rides on one person. That person may decide that they want to move in a different direction. They may decide they don't have the energy anymore. So there's risk involved in that. There's also a lot of evidence that suggests that sole founders are more reluctant to change and to pivot their business model when conditions warrant it. And we're going to be pivoting our company several times, many times during the life and being open-minded to different ideas and different ways of looking at things is important. And sole founders, just because it's their baby, are more reluctant to do that. So for those two main reasons, investors are a little bit more skeptical, or it's a little bit harder to get them to agree to sole founders. So, if you're a great technologist and you've developed a company and a product or a service, and you're out there, think about, teaming up with a great, sales and marketing person or a business development person, a spokesman type. If you're kind of the business or the operations guy, you obviously need to be going out there and finding a great technologist, to team up with. So, keep that under thought.
Yeah, and times have definitely changed. I mean, 10 years ago, you wouldn't have so many, especially in the IT and digital space, where just a single developer can really come up with a very compelling proposition that can really turn into a big business. There are much fewer of those. But at the same time, I think if you look at the world today, investors are really more aware that the developers can kind of get the idea going, but you kind of need a real strong business head to really execute on the plan and really commercialize that into a business. So they're willing to look at companies with just kind of technology people behind it, but it's a much better proposition when you can walk in the room with a complement that can really execute on the plan.
Fantastic. Thanks, Shane. Okay, so as VCs, both micro VCs and traditional VCs, the micro VCs are just basically smaller firms, right? And so they have the AUM, the assets under management of typically $10 to $50 million, although that's just a guideline. They'll do the earlier stage, right? So these guys will do seed round of financings, Series A, maybe go up to a Series B, but these aren't guys who are going to be able to are going to have the funds nor the desire to ride with you all the way through your life, but they'll be the guys who come in early, and maybe great options for those who are looking to raise several $1 million. These are guys who are going to want to understand the sector, and you need to understand the sector that you're in, and you need to be able to target the right VCs because there's so many of them. You don't want to go to someone who only invests in SaaS companies, for example, with a biotech company, right? And so you're going to have to do some research and understand, who invests in the space that you're going after. And that's also true of even traditional VCs and even angel investors. They tend to be a little bit more operator sympathetic, but they're still VCs in the end, and it's still about making that what we all call the 10x return in 5 to 6 years, right, Shane?
Yep.
And that's kind of what everyone is looking for. So you're going to have to show them that path, right, from a financial perspective, from a business perspective of how they're going to be able to get that kind of an exit in that time frame. Traditional VCs, these are the big guys that you all know, the names that you all know. They're going to have greater funds at your disposal. They're going to be able to ride with you a little bit longer. They're going to have probably a greater network. They're going to have a portfolio of companies, many of them, that you can probably leverage off of, and you can be a part of their portfolio companies. They do a thorough due diligence. You can expect them to really, really crawl up into your and really dive in. So, with all these guys, but certainly when you're going down the traditional VC, you need to have kind of the full investment folder set up, that because they're going to want to come in and do due diligence. And obviously, these guys are giving you more money. There's greater dilution. There's greater investor involvement. They're going to want to sit on your board. They're going to help drive. They're going to drive, your decision making. They're going to drive kind of the way that your business is run. And so those are the kinds of things you need to be thinking about and making sure that you're okay with that. Because some entrepreneurs really aren't. They want to maintain complete control, and in that case, going the VC route may not be the best. And obviously, the more money they give you, the greater their expectation is going to be. I highly encourage you to think through your business model. Don't be ultra aggressive. Obviously, you need to show them the returns, but don't be, don't do it where it's like, well, if everything goes well, then I'm going to be able to hit these numbers. These are the projections I'm going to show the VCs. First of all, they're not going to believe it, and secondly, then if they actually do, then they're going to hold you to it, and it won't be a pretty conversation if you're not meeting the expectations that you've set for them.
Yeah, I think at the end of the day, when you sum it up, that to even get capital in the door, an investor has to see anywhere from a 7 to 10x return as a possibility. And this kind of talks to what I was saying earlier about, certain companies don't have that hyper growth or have that ability to ever really get there. When you really look at an investment from the VC side of things, you kind of work backwards, really looking at the sales potential, looking at the market potential, but then just looking at the exit. And applying some multiples based on publicly traded things or M&A, and saying, well, if this company gets to be 300 million at exit, what do I need to own today to make it worthwhile, and how much future capital is needed beyond this? Those are all part of the calculation that goes into it. But if you also just look at the return profile of a fund itself, only a few investments are the ones that are going to actually pay for the rest of the whole portfolio. There's a lot of things that happen, even though you think you've minimized the risk. There's a ton of market pressures, competitive pressures that really change the outcome of a lot of these companies in the portfolio. And because of that, if it's just a non-starter if you can't really meet the return profile.
Fantastic. Thanks, Shane. Next slide is on venture debt, and venture debt is just another vehicle that that you can and should use in certain situations. Venture debt is where either a bank that focuses on tech companies, or there are certain companies that only do venture debt, but it's debt that is kind of an additional rider on top of an equity investment. And you'll find that this may be a great option for you to minimize your risk or to lower your risk. You get more capital in the door during a financing, and hopefully give you a little bit more cushion to be able to meet the milestones that you need to meet. It's going to be the due diligence is actually relatively easy, because the timing of most venture debt deals is kind of piggybacking an equity round of financing. So imagine if you've raised a $4 million Series A round of financing from equity investors. They've done a lot of due diligence. They feel comfortable in making a $4 million investment in your company. At this point in time, you could easily go to a venture debt company or a bank, and they might be able to add on another $1 million, $1.5 million of debt that is going to be paid back over time, but in a time frame where it absolutely increases your runway for you. And so it's something that you should think about. There's a lot of places that you can do research on it, and we'd certainly be able to provide a lot more information. I do want to kind of keep on moving here, because we still have a fair amount to cover, but this is something that you should be looking at. Shay, maybe you could talk a little bit, just about the kind of convertible debt versus equity, because I think you started touching upon this earlier.
Yeah, so just kind of set the stage. Convertible debt has been around for a long time. It's a very well-known structure. Essentially, there's a maturity period in between where some type of interest will be gained, anywhere from 6 to 8% is what's typically market right now. That will then convert at the next round of funding that comes in, and the typical discount range could be anywhere from 10 to 20%. A lot of that is subject to the time frame that's involved. Further out, typically you'll have a higher discount. We even see kind of stage discounts where, if you're willing to do this in the next 30, 60 days, you might offer up an investor a little bit of a premium. So you might offer them the 20% and then leave that open for others to come in at a 15%. Either way, it gets you flexibility. It tables the valuation discussion to a later date. It allows you more flexibility to kind of bring in capital and allow people to kind of tack onto it. Typically, these notes can remain open for a period of 90 days or so, or a little bit more beyond that, within reason. But in terms of equity, I mean, it really depends on the investor at the table. If it's a qualified and savvy investor in an institution, they may want to price the round, because at the end of the day, too, they get to mark up that investment, which is why you'll see a lot of seed deals or seed funds with the less than 50 million in assets typically price their rounds, because they're able to have confidence in the management team, the business overall, and they have a pretty good sense of where those deals are getting done. Again, the valuations in the seed stage are all over the map. They can be anywhere from really $2 million to $8 million pre-money. Again, that's before any capital is raised. The ones that are really on the higher end of that spectrum are the guys who just left a Twitter or a Facebook or some other rock star company and have really carved out an interesting niche in the market. And it's really just kind of a tier one management team that's ready to execute on another big idea. So I think in general, see kind of in the $2 to $4 million is where pre-monies will exist on the equity side.
Great. Okay, next slide, and this is kind of the game plan or the fundraising, some of the things that you need to think through, and obviously you need to think through all these questions, but I want to focus on the first couple, and that's about milestone financing. We are a huge proponent of milestone financing, and what we mean by that is, and that's a little bit of background. So, the valuation of your company is not going to increase linearly. It's not going to be a curve, right? It's hopefully, if you're doing things right, you're going to have big step function increases in valuation, and those increases in valuation are going to happen when you hit milestones, right? And it may be, first customer, it may be the first, some number of eyeballs, it may be, the hockey stick increase in traction. Whatever it is, those milestones and the milestones you're trying to hit, those are the things that you need to be thinking through, and you need to kind of use those milestones and say, hey, these are the milestones that I need to hit. If I hit those milestones, I'm going to get a big increase in valuation before my next round of financing. And so let's think about how much money do I need to raise today to enable me to get to where I need to go, hit the milestones that I need to hit, so that when I raise that next round of financing, I'm going to have already hit those milestones, and I'm going to be able to raise that next round of financing at a much higher valuation and give up less of the company than if I were to try to raise more money today. And that's really the goal. And so that's the kind of the thinking that I want you guys to go through as you're thinking about how much and where the money's going to come from. But it's really about, okay, let's back off from the milestones that we need to hit. And that's how we should back into kind of how much cash we need. And then going kind of into that, how much should you raise? And it's kind of these different factors that I think if you kind of put it all together, it will probably give you some sort of an idea of what might make sense, right? And so, part of it is, I think like I said, you should start with how much do you think you're going to need, and you should be thinking about it from the next 12 to 18 months. I really push for 18 months, thinking about the milestones that you're going to hit. And some people say 12, but if you really think about it, fundraising is a 6-month process, and fundraising is a 6-month process, and is a full-time process for at least one individual. One of the founders is going to be basically spending full time. It's tiring. It's very involved. And so the last thing you want is to raise money and say, phew, okay, I got some money in the bank. Now I can focus on product development. Now I can focus on customer acquisitions. And you put your head down and you're cranking away and you're making progress. And now 6 months later, you realize, oh, shoot, I've only got 6 months of cash left because I raised 12 months of cash. And now I have to start the fundraising efforts again. If you raise for 18 months, then what you've done is you've given yourself a good 12 months, a good year to really focus on hitting some of the milestones and getting a lot of traction. And so that's kind of the first place you start.
I would say the only thing to add to that, if you are going to go down that path of trying to get 18 months of runway, try to align yourself with the best financial institutions or investors that you can retap for additional funds. So in case you do kind of reach the bridge and need additional capital at month 18, they actually have deep enough pockets and reserves to continue to support the company.
Yeah, that's great. I think from a dilution standpoint, every single time you go out for an equity round of financing, and I'd love Shane's viewpoint on this, but I think if you target a 20 to 25% dilution, every round that you're going, at least in the first 2 or 3, that's probably a good target. I think that makes sense for both you as well as any investor. So obviously you want to give up less. The investors want to take on more, but that's probably a good compromise.
Yep. No, I mean the market's the market, but I think you just need to have a mindset, and I would say anywhere up to 1/3 of the company could depend. Really depends on the scale of dollars and the amount that the company is trying to raise going forward.
Yep, and then kind of the third part of this is the valuation. And there's lots of things about it. You can look at comps, you can look at market opportunity, you can look at traction that you've got, all of those things. But if you put all that stuff together, hopefully what comes out is a range, right, of money that you're willing to the amount of money that you need to raise, what kind of valuation you have for your company, and the fact that you're trying to raise this money and that's going to get you into the dilution of the 20 to 25 or maybe even up to a third, and then hopefully it kind of fits into that range. And if not, then you probably need to think about, okay, well, what's the difference here? Why am I so off? Is my valuation really, really off from kind of what I think it's going to be, or am I having to give up too much of my company to raise this money? Maybe I need to go back and sharpen my pencil in terms of being able to do more with less cash, and so maybe I could raise a little bit less cash. So this is kind of a good starting point to think through those issues. So the process of this, and you can kind of read the bullet points here, but the main thing is that you have to think about this from a almost like a job search perspective. You're going to be out there talking to tons of people. As Shane mentioned, 1 out of 1,000 business plans get investment from equity investors. You need to devote a lot of time, both time as well as bandwidth, to really, really go after it. Try to meet as many people as you can, get introductions to investors, do research on the types of investors that you're going after and the sweet spot that they're after. I highly recommend you really target some investors and say, okay, here's why I think an investment in my company fits the investor's profile, as opposed to, hey, I just need some money, so I'm just going to talk to as many people as possible. Try to find that right fit. Rely on your ecosystem for investor intros. I mean, if you think about 1 in 1,000 getting funded, and you can imagine how many business plans and executive summaries these guys see on a regular basis, trying to get an intro, trying to meet with them or have them look at your business plan without an intro from someone that they already know, you're fighting an uphill battle. So you need to figure out, who that can make intros. I get the question from entrepreneurs, well, I don't know that many people, and I don't know anyone who knows that company. Should I go ahead and send a blind email or a blind business plan or a blind executive summary? And the question I come back with is well, if you think about it, and again, an entrepreneur, an investor is thinking about minimizing risk for his investment. Their job is to know as many people as possible. If you can't find a way to network yourself into a warm introduction to that investor, what does that say about kind of the risk involved in investing in you versus someone else who obviously has the wherewithal to be able to find their way in? So I highly discourage it. Although again, I wouldn't say no at all costs, but I highly discourage it.
And sir, a couple quick questions. We have 3 actually. One is, what should we be doing as entrepreneurs to maximize our ownership after continued dilution round after round?
Hit milestones and gain traction. Because ultimately, right, every single equity round of financing is obviously a negotiation, right? And negotiations, the outcome of negotiations are based upon strengths and the relative position you have. You are one company. You're selling yourself. Obviously, investors are interested in investing in you. The more investors interested in you, obviously, the higher the valuation is going to be, and the less of the company you're going to have to give up. And it's about the traction. It's about it's about just going out there and really being successful and executing, so that when you do get that next round of financing, you can point to all the things that you did, the milestones that you hit, and the big increase in valuation in the company, and being able to sell it that way, and being able to attract not just one investor but several investors who all want to get in and invest in your company.
Perfect. And then there's another one that says, are you saying even for friends and family giving up 20 to 25% of the company, or are you talking about big VCs?
I'm talking about an equity round of financing. So in an equity round of financing, that convertible debt that you get from friends and family is going to be included in that first round of financing. So it'll be a part of it, but certainly you wouldn't be giving up 25% of your company to borrow a little bit of money from your friends and family.
Perfect. And that was kind of a two-part question, so we are good to go if you want to move forward.
Okay. Shane, do you have any thoughts on that? Any additional thoughts?
No, I think that's fine.
Okay. The choosing your target VC, and I think this is pretty apparent. There are several things that they look at, and Gina, if you could forward on to the next slide. It's every VC has their own sweet spot of investment that they're making, right? And it may be the stage of the company, the round, the amount of money, the industry, the focus that they have. You should be looking at the other portfolio companies that they've invested in, and being able to see a fit and how you might be able to help some of their portfolio companies, and they might be able to help you. They love that interaction, and they love that. Putting together a group. It's things like that you have to look at when you target your VC. But the big thing here is you need to do your research, and you need to target VCs. You don't want to just spam as many as you can in the hopes that it becomes a numbers game. By the time you've reached out to VCs, you should have done a lot of research, and you should know your place within their portfolio, and be able to explain to VCs why they should invest in you, right? Because they've probably seen other business plans that are similar to yours.
Yep. The only thing I would add is that it's a long process and it's a long relationship, so you want to choose the ones that you want to be around. It's really no different than a marriage.
Yeah, and it's not even just about money, because obviously you're going to get the money, and that's one of the first things you're looking for. But it's also about, okay, how can they help you? They should be adding value, not only just from a money perspective, but making introductions to key players, making introductions to their other portfolio companies that might be able to help you, and making introductions to service providers that can help you. All those things are value adds that VCs bring. That other smaller investors may not be able to bring, and one of the reasons why you're going to them, and they're taking a bigger percentage of your company. So think through those things. Gina, if you could go to, I think we're a couple of slides back. So one more. So on the network side, basically you just need to network, and you need to network with as many people as you can. You need to get introductions into investors. Other entrepreneurs are great sources. If you can reach out to portfolio companies of investors, that might be good fits and good partnerships that you might be able to make, or the technology might be. Might work well together, then that's a great way of doing it. We love co-location spaces and incubators, because you're just surrounded by a bunch of entrepreneurs, as well as the people within these organizations who can make introductions. I work with a company that does finance and accounting, but we are players in the ecosystem, in tech startups and with investors. Every partner that you're working with, every vendor that you're working with, you should be asking the question, okay, maybe not today, but 6 months from now, when I'm looking to raise some financing, when I need introductions to investors, will you be able to help me, right? So things like lawyers and bankers and payroll service providers, insurance service providers, ask that question, because everyone that you're working with should be a potential source of a referral or an introduction to an investor, or to some investors. The next one is basically the kind of what you need to present to investors. There's basically three main things. Gina, if you could move forward. There's an elevator pitch, and that's kind of the 30-second spiel. If you get caught in an elevator and someone asks what you do, you should be able to tell them with passion the things you're trying to do. And it shouldn't be a description of your product, but it should be about the passion and the dream and what you see happening in the future with what you're doing. The executive summary is a 1 to 2 pager that has more information that someone, if someone says, hey, I want to find out a little bit more about your company and what you're doing, can you send me something? Then this would be the next step. And then the final thing is obviously the pitch deck. And so as you go down the line, you're basically trying to get people to be interested enough to take the next step. So, when you speak with someone really quickly and you, in 30 seconds you tell them what you do, their response should be, oh, that sounds really, really interesting. I'd love to see an executive summary. And when they read the executive summary, there should be enough information in there and enough of a market potential and a business potential and an investment potential for them to say, okay, I'd love to see the pitch deck and I'd love to have a meeting with you. And obviously, as part of that pitch deck and as part of the thinking, you need to put together a financial model. And we're the ones who put together these slides, and we're finance people, so we always add that in there.
And you can find a lot of good examples online for a lot of these documents. So, but anyone on the phone here presenting can also give pretty good examples to follow. The last thing on the financial model, the only thing I'd point out there, the last thing you want to do is create a top-down version of a model that basically says, hey, if I can get 2% of this market by year 5, you'll get a 10x return. That just doesn't fly. I think it shows a very poor level of sophistication. When you really are planning financially, you need to build from the bottoms up. You need to understand what your sales cycles are, what your churn is, what the average sale looks like, and how it's broken into tiers, and then add all that up. Like, how many do you think you can achieve per month? Given the sales cycles and conversion rates, things like that. It all needs to then funnel into then a broader picture and kind of create a summary of a financial picture rather than just kind of taking a snapshot of the overall market and trying to get a fraction of it.
I love hearing that, Shane. We couldn't agree more. There has to be a lot of thought put into this, unless you're an entrepreneur who's already had a couple of successful exits and can basically raise funds on your reputation, on your name. And there are people out there that are like that. But for most of us who are first timers or don't have successes under our belt, you need to really think through all of these issues and be able to present it in a manner that makes the investor understand that you really understand the space. What it takes to be successful here, and again, it's about kind of lowering the risk profile from the investor standpoint. The next slide, the key slides, and I recognize that we're kind of running up on the hour here, so I want to at least get through this because there has been a lot of information. But the key slides in your pitch deck, and as Shane mentioned, you'll see lots of examples out there on the web. But we're big believers in the 10-20-30 rule. 10 slides. 20 minutes and 30 font, right? And try to limit it to that. If you need to go more in detail than that, then you're probably not communicating in your pitch deck at the right level of communication. But there's lots of examples. Gina, could you move forward, please? So yeah, these are the kind of the 10 typical slides that you would see. But like I said, there's lots of examples on the web. More graphics, less bullet points, less type. Graphics, charts are definitely the way to go. I love the kind of when you look at the market and the problem and the solution, I love the before and after, right, slide, which says that, hey, this is the way the world works today. This is the way the world is going to look after we're successful. I love that, and that really hits home with investors, and they get it, and it's a great way of communicating what you're trying to do. And with that, I think there's probably just a couple slides on the financial stuff. I think Shane really already hit it, which is that that you need to be doing a model that's bottoms up and not tops down. We kind of touch upon both things here, but I do want to be respectful of the hour that you've given us, and I think that we've touched upon kind of the main points. The financial model, if you should be thinking through all those assumptions. You should be thinking through things like cost to acquire a customer, customer acquisition cost. How long are they going to be with us? What kind of churn do we have? What kind of monthly rate or annual rate are they going to pay us? What percentage of email campaigns, turn into clicks and turn into sales. All those types of metrics are available to you for most types of industries, and you should be, understanding those, and you should be applying those to your assumptions as you put together your revenue projections. And then once you put your revenue projections together, you need to think about all the resources you're going to need, the people that you're going to have to hire. When are you going to have to hire them? What levels? How much advertising dollars am I going to need? How much capital am I going to have to purchase? All those things you need to be thinking through from a bottoms-up perspective to really put together a compelling business or financial model that investors will be able to trust. And I think Gina, if you could just kind of go forward a couple to the pitch deck pitching tips, and these are kind of the final things that I'll leave you with, and I'd love Shane's thoughts on this too. But it's let the best pitcher pitch, right? If you're an entrepreneur who you're the founder, but you're the technologist, and there's someone who can relay the message during a presentation better, let them do it. You're there to answer questions. You want to put your best foot forward. Charts and graphs, I think, replacing those with words, we talked about that. You should know your numbers really, really well. You don't want to put a spreadsheet in your pitch deck, but you should have them in backup slides, and you should absolutely know the numbers. So when they ask you these questions, you should be able to answer them with no hesitation. And the final thing I'll talk about are things like body language and the psychology of that pitch. Look at make eye contact. Look for cues, visual cues from investors. If they're leaning back, they're probably a little bit less interested. If they're really leaning forward, really be aggressive and pursue. You'll get a lot of investors who will try to pick and prod. They want to, in some cases, they're not that enamored with the model, and they want to understand it better. But sometimes they just want to see how you react. So they want to see, when they push you, how you react. Are you going to get defensive? Are you going to be easy to work with? These are questions that they're trying to get at sometimes. And so just control your emotions, answer the questions thoughtfully. Acknowledge that the question that you're being asked is a good question, and you want to give it good thought. You don't want to be flippant. You don't want to be the smartest guy in the room. These guys are really, really bright too, and you need to acknowledge that. So I guess those are kind of the final points that I want to leave you guys with. Shane, what else?
Yeah, and the only thing I would add to that is just know your competition. I would say know the competitive landscape, be able to speak to all the key players in the field, knowing the pros and cons of their platform solutions, things like that. Also know the investor's portfolio and where there might be fit or synergy, or where you see there's opportunity. I think just having the amount of domain expertise and really showing that you know the space only works in your favor.
Absolutely, and don't minimize the competitive slide. And I get to ask this question too. Well, hold on a second. I want to be a little bit careful about who I put in as a competitive slide. What about bigger players who aren't necessarily doing it, but were close enough where they could do it? Do I put them in there? And I say absolutely. Why not? I mean, there's no competition is not a bad thing. I mean, if you're trying to suggest that there's very little competition, then that tells me, and that tells investors one of two things: that you either don't know the competition that's out there, which makes you a little bit naive to the domain, or that there really isn't a big enough market. I mean, in most cases, you're not going to be the only one with the idea. You may be doing it a little bit differently. You may be attacking a different niche or what have you, but there are other competitors out there to what you're trying to do. Yep. Or if they're not, then there could be. Put them up there. Explain to investors why you are the one that they should be investing in, as opposed to some of these others.
Yeah, and the last thing I'd say to that is there's always competition, because doing nothing is an alternative, right? Not even changing or adapting to whatever you might be selling. That's competition right there. You're still vying for the same time and dollars that someone else is trying to offer. So
fantastic. And everyone, I really appreciate that you've given us a little bit of extra time. I know we're already over the hour, and so I think that's probably everything that we wanted to cover, probably even a little bit greater detail.
Oh, sorry, we have a couple questions. Do you want to go through and answer them, or would you like me to send them to you individually?
Oh no, absolutely.
Okay, so our first question is, Female entrepreneurs spend 2/3 as much as men to achieve the same milestones. Companies that have women in C-level positions are more profitable than companies without. Why aren't women being more, and it's not letting me go down for some reason. Why aren't women being more, let's see, being more funded?
Oh boy. Shane, do you want to take that one?
I don't think there's a discrimination issue. I think it's there are funds that specifically focus on women-based run businesses, but it really just comes down to what you're going after, your level of skill and the market that you're addressing. I don't think anybody is adverse to one way or the other, but you still have to have the same ingredients as any other deal to really make the point. So everybody's in the same race.
Absolutely. There is absolutely no discrimination. Trust me when I tell you that investors are looking at every single investment opportunities as a standalone. If the law of large numbers say things of that nature, and I know that the statistics support exactly that point. You could probably point to a lot of other things. You could speak to maybe a level of aggressiveness as a whole. Female versus male. There's other factors, but on an individual basis, absolutely not. I think every investor is going to be looking for every opportunity to get a leg up and invest in great companies and great management. As Shane said, there are absolutely funds and firms that invest primarily in women-owned companies and women-owned startups, and so those might be great options to at least start with. But there isn't any specific reason for it that I would speak to, other than just kind of general, there's just differences, unfortunately, in the numbers.
I mean, anyway you slice it, male or female, 10x is a 10x. So it's all about how you get there.
All right, our next question is, I'm a first timer, would like to know where and who can help me find investors and guide me through the process. Also, how do I obtain or find firms that are looking for investors so that I can also obtain possible investments for my private investors? Did that make sense? Or do you want me to break it up into two parts?
Well, it sounds like you have two people on the phone right now that could definitely help in the first part. The second part I'm not fully following. It sounds almost like that might be an advisor that wants additional funding for other deals.
I'm not 100% sure. It says, how do I obtain or find firms that are looking for investors so that I can also obtain possible investment for my private investors? So I guess maybe attack the first part. A first timer who'd like to know where and who can help find investors and guide them through the process.
So I think it really comes down to the service provider question. A lot of people maintain relationships. Some people do it better. I think that's just an interview process you need to have with accountants, lawyers, bankers, just any type of advisors, and just kind of see where's the best fit, and also who has the best Rolodex and who's actually going to spend the time to do it. While a lot of people do maintain relationships, it doesn't mean they're actively managing those. So it's one of those things that you just have to feel out on your own and see who's going to really help deliver.
And I'll add to that and probably put in a little bit of a plug for companies like ourselves and DLA, and that is that again, these are the questions you should be asking, but ask pointed questions. So for example, when you're thinking about hiring a lawyer, yes, of course it'd be easy to hire someone down the street or someone local who charges a low hourly fee, and that's fine in and of itself. But boy, think about the value add that could happen if you work with someone like DLA, and if you talk with an attorney who's focused on startups, and they can help you on the legalese and the contracts and setting up the company, and then, oh, by the way, they say, oh, and we've got this group headed by Shane here who could really help you through the process and make introductions when the time comes. I mean, that is invaluable. I mean, that's so much more value add than any incremental additional cost that you might bear to get a high-priced attorney at DLA as opposed to a local guy down the street. I mean, those are the things. I mean, we all talk about being penny wise and pound foolish. This is a classic one that I see all the time. Work with bankers who can make introductions. Don't bank with Bank of America or Chase. Those guys can't help you. Work with some of these smaller banks that are focused on tech companies. Work with Silicon Valley Bank, Comerica, Square One, guys like that. Work with law firms like DLA who really are major players in this ecosystem. And when you're looking for accounting people, work with people like Early Growth. Don't talk with a local CPA who can we can all do that work. The question is, what else can we do that might be able to help you during this process?
Yeah, another thing I'd add to that is like larger firms like DLA, because I can give you a great example there. Because of our scale and size, we can afford to take early bets on young companies, and we work with them day in, day out. Doesn't mean we charge them the highest rate. Sometimes we do deferrals. We have a program called Nest that is out of our Austin office that is kind of billed out at a much lower rate, but you still get kind of tier 1 service. So at the same time, you might think that there's a high sticker tag on it, but at the end of the day, there's a lot of services and programs within those organizations that can help you through the early stages.
Absolutely.
Okay, then I think that's it, and that brings us to the end of our presentation. I just want to say thank you to all of you so much for joining us today. We very much appreciate your time and hope you found this useful. If you have any follow-up questions, please feel free to email us or tweet to @earlygrowthfs, #startupfunding. Should you wish to join us again, we have another fantastic webinar coming up on December 17th at 11 o'clock a.m. titled Building Your Financial Model, Key Startup Metrics. In addition, please feel free to check out our events webpage to register for this or any other upcoming webinar. We hope to connect with all of you again soon. Thank you again to Shane and Cirque for a fantastic presentation and to all of you for attending. We hope you have a great day.
Thank you, everyone, and happy holidays.
Thank you.